everyone. It's a pleasure for me to be here and to have the opportunity to talk about the topic that I like very much, and we already touched several times yesterday. Luckily, not much spoiler happened, and this is the global minimum tax and its impact on the Hungarian tax system. I would like to structure my presentation in the following way. Very shortly, I will talk about it, why it's so important, this development, both at EU level and at international level, what are the sources of the rules, and then I will just very shortly, without going into technical detail, I will present some features of the Hungarian tax system, focusing on the tax base, the tax rate, and certain tax credits, and then the core part of my presentation will be found under point 4, that how this new set of rules under the global minimum tax interact with the Hungarian tax system, with special regards to its incentive elements. And then I will finish with some closing remarks. So yesterday, Professor Bohinc already mentioned that not much harmonization took place in the field of direct taxation. We can find some tax coordination harmonization, where there is some exchange of information between tax authorities, and also some mandatory disclosure rules. And also we can find some directives that try to mitigate the negative effects of doing business cross-border. This is the parent subsidy directive, interest royalty directive, or tax merger directive. And then we have a more recent directive, the ATAD 1 and ATAD 2, that are meant to prevent certain tax avoidance strategies done by multinational enterprises. By contrast to them, which are all entail some sporadic harmonization, the global minimum tax rules really entail comprehensive harmonization, because they are meant to set a floor to tax competition, and they want to ensure that multinational groups they pay at least 15% of effective tax rate in each jurisdiction where they operate. And they try to achieve it in a quite transparent way with the transparent rules, but at the same time, it also entails a very high administrative burden, both on the tax administration side and on the taxpayer side. So the GLOBE rules have been developed at the level of the OECD, where the reach goes much beyond the European Union. Originally, there were three set of guidance, the GLOBE rules themselves. Then they were explained by a commentary and some illustrative examples. And this is the form that was basically incorporated in the EU directive. At EU level, a consensus has been reached at the end of 2022 and incorporated those rules. However, it turned out very quickly that those rules, they left many very important questions unanswered, and these questions were bombed towards the OECD from the tax administration side or taxpayer side, tax advisor side to answer them, and the OECD was pretty keen on answering them, and new administrative guidances have been issued, many actually of them, and the problem that they already included even some new rules compared to the original ones, or sometimes they even interpreted the original rules in a way that is different from them. And here we already have a problem that at EU level we have a binding directive, and the member states are obliged to transpose the provisions of this directive into their domestic tax system. However, later on we had some, we can say, new rules that cannot be found in a binding document from an EU law perspective. So it will be very interesting to see how this discrepancy will play out on the long term. And the GLOBE rules, the global minimum tax rules, do not affect all enterprises. Only multinational groups are within the scope that derive at a group level at least 750 million euro. So here we can see that the threshold is pretty high, and they try to prevent them from being very lowly taxed. And here it calculates the effective tax rate of this multinational operation in each jurisdiction on a jurisdictional basis. And basically the effective tax rate is the result of a fraction where in the nominator we can find the covered taxes, and it will be divided by the so-called GLOBE income. And then if this effective tax rate is lower than 15%, then on the difference there will be a top-up tax levied, However, if there is a substantial operation in the given jurisdiction in the form of having a lot of payroll, having a lot of tangible assets, then it can be deducted from the globe income, and the top-up tax basically will be levied on this so-called excess profit. And so in the numerator of this fraction, we can find the covered taxes, the scope of which goes beyond the mere corporate income tax, because any tax can qualify as a covered tax that can be regarded from the point of view of certain accounting standards as income taxes. In Hungary, there are 4 types of taxes that can fall within this category. Besides the corporate income tax, there is the local business tax, innovation contribution, and the income tax of energy suppliers. What is particularly important and relevant is the local business tax, because it is levied on a much wider basis than the corporate income tax. Because even though the starting point of the local business tax base is the turnover from economic activities, however, and it also allows for the deduction of certain costs, however, not all of them. And some very important cost elements cannot be deducted from the tax base. For example, the labor cost, so any payroll that is paid, also the depreciation of assets, it can be also extremely high, and also interest expenses. Consequently, it can result for certain companies in a very high tax liability. And in the denominator side of the fraction, we can find the globe income. Here the starting point is the financial accounting profit or loss, and then it allows for certain adjustments. These adjustments are typically aligned with the typical tax rules that can be found in the tax systems of many states. Obviously, the net tax expense is eliminated. Also, dividend income and participation exemption income is excluded, with the exception of short-term portfolio investment, which means an investment where the shareholding is less than 10%. Also some FX gains or losses and similar items. And I know that people who bring a lot of numbers to legal conferences are not very popular, but we are not going to go into the details of the calculation. It is just an illustrative example to see that what happens when we have a multinational group with, in this example, with 3 constituent entities located in 3 different countries. Then we can, after the calculations, we can see that in country B, there is not sufficient tax have been paid, and that's why there is a top-up tax liability at the level of constituent entity 1. The question is, who can collect this top-up tax? Here we have an ordering rules. First of all, these global minimum tax rules enable the low-tax jurisdiction itself to levy a so-called qualified domestic top-up tax and collect the tax itself. So the primary right goes to country B. However, if this qualified domestic top-up tax is not introduced, because it's just an option, not mandatory, by this country, then the secondary right goes to the country of the ultimate parent company, and it can levy this top-up tax on the ultimate parent company itself in the form of a so-called income inclusion rule. And even if it's not introduced, then there is a so-called backup, which is the UTPR, the under tax payment rule, and it allows for any state where this multinational group has some substance to collect this top-up tax. It's basically meant to ensure that even if one country introduced the global minimum tax rules, then this top-up tax will be collected somewhere. And now I would like to turn to the main features of the Hungarian tax system. Our corporate income tax calculation starts with the profit before tax, as derived from the financial accountings. And then in order to arrive at the tax base, there are certain modifying items. With the participation exemption regime, I already talked about it. It means that any gains from the alienation of a shareholding is exempt from taxation. Also, dividend income is exempt from taxation. We have a very liberal IP box regime, which means that income derived from intellectual property is also taxed in a quite beneficial way, and also research and development related deductions are allowed. And then when we arrive at the tax base, it will be multiplied by the one single tax rate, which in our case is 9%. And then we get the tax payable. However, it's not the ultimate tax liability, because it can be further reduced by certain tax credits. And I would like to mention 2 very important of them. One is the development tax credit. It relates to very strong and significant investments that create jobs. And the other one is another research and development related tax credit. And after those deductions, we can finally find what is the tax liability of the company. And now let's see how these rules interact with the global minimum tax rules. I already mentioned that also in the globe income, we can exclude most of the dividend income and the participation gains, with the exception of short portfolio investment. However, the Hungarian tax system does not make this distinction, which means that it can be quite detrimental for those companies that derive significant either dividend income or any other shareholding-related income when it comes to low shareholding, which is less than 10%, because they are involved in the calculation of the global minimum tax rules, but at the same time, we will see that in Hungary there is no tax on them. The same applies to the R&D deduction. This double deduction of research and development costs can significantly lower the tax liability and consequently the effective tax rate. And the IP box regime basically enables taxpayers that if they derive any income from intellectual property, royalty income, only the half of them will be taxed, which means in the case of a tax rate of 9%, that effectively they will be taxed at a rate of 4.5%. And for tax credits, I think that's the strangest part of the global minimum tax rules, because they make a distinction between qualified refundable tax credit and non-qualified refundable tax credits. And when a tax credit qualifies as refundable, when it can even go beyond the tax liability, so it can turn the tax liability into a negative liability, which is basically a refund from the government in the form of cash to the company itself. And also, if it's not utilized by the company within 4 years, then again, it must be paid by the government in the form of cash. And in such a case, it will only very lightly affect the effective tax rate. And in the case of non-qualified tax credits, it will significantly reduce the effective tax rate. And in the Hungarian tax system, all of our tax credits, and I think in most countries, the tax credits are in the form of a non-refundable form. To the extent I know, the only exception is basically France, and this rule was the outcome of a very strong lobbying activity of France when there were the negotiations of the global minimum tax rules. Consequently, both of the Hungarian tax credits that I mentioned will significantly reduce the ETR, the effective tax rate, and they can be affected by the globe rules. Now, I would like to talk a bit about how the Hungarian parliament reacted to these new changes. And you might find it quite interesting at first sight that the tax rate, which is way below the required effective tax rate, 9%, remained untouched. But actually, in my view, it is quite a rational choice. First of all, the global minimum tax rules only affect certain companies, certain groups. As I already mentioned, the threshold is pretty high, so most of the taxpayers will not be affected by the global minimum tax rules, and it's rational to keep the 9% of tax rate. Also, Hungary introduced this qualified domestic top-up tax, which also means that even if we come to the conclusion that in the case of certain groups, this effective tax rate is lower than 15%, the primary right to collect this extra tax will come to Hungary, to the low tax jurisdiction. So there is no much tax loss anticipated. And due to the concept of the covered taxes, it is, and we already seen it in practice, that many large multinational groups are actually taxed at an effective tax rate of 15% or even above, even in Hungary. Because if they have very substantive economic activities, just think of a car manufacturer, for example, with a lot of payroll and a lot of tangible assets, then they are quite likely to pay a very high amount of local business tax, even if they pay just a very low corporate income tax. But local business tax is also included in the covered tax category, and consequently, their effective tax rate can pretty much above 15%. And one more aspect that is interesting to talk about is that the effective tax rate is calculated on a jurisdictional basis, not on a corporation by corporation basis, but on a jurisdictional basis. So it's possible that there is one group company in the given jurisdiction that is very beneficially taxed below the effective tax rate, but there is another one in the same group that is highly taxed, and their effective tax rate will be blended together, and on an aggregated basis, it will reach the required percentage. All the other benefits that were related to the tax base, like the IP box regime, the participation exemption regime, or the R&D deduction, they also remained at place. It's also a quite rational choice, especially in the case of the participation exemption rules, because as I mentioned, also the globe rules by large exclude these benefits from the scope, and only for portfolio shareholding can it be problematic. However, due to this distinction between qualified refundable tax credits and non-qualified refundable tax credits, it really hits the tax credit system of Hungary, and I think the system of many other countries with similar tax credits, and there were already legislative responses to them. Regarding the R&D tax credit, it was converted starting from 2024 into a refundable tax credit, which means that it can also reduce the tax liability to zero, unlike in its previous form. And it also means that if it's not utilized within 4 years, then the government will pay this amount in the form of a cash. So even a taxable income is not required anymore, because even in a loss situation, this credit will be paid in the form of cash. The development tax credit did not change, so it's still there. However, an alternative has been developed in the subsidy system of Hungary, only for companies that are within the scope of the globe rules, and it is basically a cash-based investment incentive. So here the rules have been duplicated. The tax credit remained for non-globe companies, and cash subsidy have been created for globe companies. So some concluding remarks. The global minimum tax rules indeed pretty much exert an impact on the tax sovereignty of the member states, but there are a lot of mitigating effects. It's important to harmonize that, to emphasize that they did not entail the harmonization of the corporate income tax rules. Member states are still free to design their corporate income tax system as they wish. However, if it results in a low taxation, then a top-up tax liability might arise. Also, even in a country like Hungary, which has one of the most competitive corporate income tax systems, we have seen that most of the incentive elements could remain in their original form without significant changes. Also, the option to introduce a qualified domestic top-up tax basically enables for this low-tax jurisdiction to exert their taxing rights over this top-up tax. And also the competition, I wouldn't say that it really stopped, because we still have the majority of the companies are out of the scope of the globe rules. And also we still have a persisting competition over the effective tax rate of 15%, because it does not mean that in every country the effective tax rate will suddenly be reduced to 15%. We still have higher tax jurisdictions. And these globe rules even created a new tax planning opportunity due to its jurisdictional blending, because it's pretty much possible that if there is already a high-taxed activity, like I mentioned, a manufacturing activity, then it can be blended together with some low-tax activity, for example, financing activities or holding activities, in order for them to be aggregatedly achieve a 15% of effective tax rate. So there is still plenty of leeway for member states to design a competitive tax system. And these were my final remarks. Thank you very much for your attention.